Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, first quarter earnings season off to a bit of a weak start, but are you seeing any signs of stabilization at all?
Yeah, I mean, certainly what we've been seeing out of the financials, at least on an accounting basis, looks quite good. The recent numbers that aren't really incorporated into this report, we've had Wells Fargo coming out and saying everything's wonderful, and then yesterday we had Goldman Sachs come out with much better than expected numbers. Now, granted, it's a 4-month quarter because they had to shift their fiscal year when they became a quote-unquote bank. So, I mean, it's a little bit of an apples to oranges comparison, but still much better than most people were really dreaming of.
When you talk about those bank stocks, you've got to be careful there because a lot of people, are saying the banks are profitable, but they're profitable on an operating basis, quite possibly. But they're still likely to be forced to book massive losses on, soured loans.
I totally agree that there are a lot of very shaky things still out on that balance sheet, and if you were honestly to mark these things to market for what people are willing to buy these assets for, a large part of the banking system would probably be insolvent. But if they are profitable on an operating basis, it gives you some hope that they can sort of earn their way out of the hole. And that's part of what the Fed was up to when it decided to cut interest rates down to zero, is to essentially try and help out the banks by letting them have a huge net interest margin and try and work their way out. You combine that with cutting dividends, and it is a hopeful sign. I don't think it's necessarily sufficient, given the huge magnitude of the potential losses, not only on the sort of legacy assets that everybody's, the old subprime problems, but as unemployment rises, you're going to see more and more defaults on credit cards, and we actually have more delinquent prime mortgages today than we have delinquent subprime mortgages. Now, as a percentage of the total, it's not as big, but in terms of raw numbers, there are more prime delinquencies and mortgages than subprime delinquencies.
Okay, so a lot of question marks regarding those bank corporate profits is the point there, to say the least. Overall, first quarter profits for S&P stocks down?
Oh, down, and we're looking at close to a 30% decline in this quarter, and then even in the second quarter, we're looking at about a 25% decline. So, I mean, not as bad as the 62% decline in the fourth quarter, but that had some asterisks in that so much of that decline was due to a couple of the financials, AIG, Citigroup, firms like that. So if you'd stripped those out, it looks probably at least as bad as the fourth quarter was.
Well, profits in all economic sectors for Q1 weak across the board?
Yeah, every sector is going to report total net income that is less than the total net income in the first quarter of 2008. Now, in the case of healthcare and consumer staples, you're talking about really negligible declines, less than 5%. When you're talking about the more economically sensitive areas, particularly the consumer discretionary materials, which are largely commodity companies, and energy, you're talking about some very, very large declines of over 50% for all three of those sectors.
What about healthcare? I heard some talk a while back about maybe some modest growth in healthcare.
Well, healthcare is expected to be the best of the bunch, but we're still looking at a 1.6% decline. It's close enough to zero and with a couple of positive surprises, could eke out over that zero line. And is clearly the strongest No, excuse me, I take that back. Consumer staples is down 1.6, healthcare down 2.9%.
Okay.
But again, those two sectors are the two that could very easily, with a couple positive surprises, break over the zero line.
Do you look for much in the way of guidance from companies for their guidance going forward into 2 and 3Q?
The guidance. A lot of companies have been ratcheting back on how much guidance they're giving, and we don't specifically track guidance. We do it indirectly through how the analysts react to the earnings. Since the first quarter is part of the full year 08, and if you have a positive surprise in the first quarter, if analysts don't respond by raising the full year numbers, obviously then there's been some guidance saying, guys, this is kind of ephemeral, and we're going to give it back in subsequent quarters. So that's kind of a very telling clue as we get into the heart of earnings season, whether we start seeing the revisions ratio improve. Because as it stands now, we're still seeing more than 3 cuts for every increase, and that's across the board for 2008. The only sector that's hit the equal mark is telecom, but that's 8 estimates up, 8 estimates down.
And we've already said in the past that's a small sector.
Small sector, and the industrial sector is really getting slammed right now in terms of cuts.
Okay, 3Q still up in the air?
3Q is still up in the air. We don't really start pulling the numbers together for this report until after the first quarter numbers are in for the third quarter, and we've got some of the estimates out there, but the sample size tends to be so thin as to not be that significant, and so we don't pay much attention to it yet.
Okay.
But implicitly, from the expected growth rates for the full year compared to what you see for the first and second quarters, there is a second half recovery that's implied. Then again, also you start getting easier and easier comparisons as the year wears on.
Right, so more question marks the further out we go. We're going to have to leave it there for time. But if you want to see Dirk's latest earnings trends commentary for this most current week, go to Zacks.com, scroll down the homepage until you get to the headline next to his picture, and that link will take you right to it. He fills in all the blanks with all of the most recent numbers on the scorecard and some other commentary that we just don't have time for here as well. With Dirk Van Dyke, I'm Terry Ruffalo.